Okay, good evening, traders. Here had one of the viewers who had viewed the return covered call video said he didn't quite understand the covered call strategy. So hopefully this video here will help explain it. What we have here is the micro ES pulled up, and when it says right here buy a share, it's basically buying the future contract. Okay, and this is for July the 3rd. As you can see, this is the call where you sell the call right here. Now, showing buying the future at 44.82 and selling the 44.80, which is in the money call. So it shows it, I believe you're going to buy it for about sell the call for about 14 points or so. So in this green right here, so basically when you sell a covered call, what you're hoping for is the fact that the future in this case, or stock, would expire anywhere in this green area. So as you can see right here with the future at 44.82, anything above it will show you a profit of $42.50 at expiration. And if you don't actually start losing money till you get down here, as you can see, as you go further and further down, you lose more money. So it's showing you ballpark figure here about 44.72. So about a 10-point reduction before you actually start losing money. Now, if you move up and sold the above the, you're buying the future at 44.82, you can sell the call above it, which in this case, as you can see, you would make $53, because what would happen is the future would be called away from you at 2.5 points higher than what you're buying it at. Plus, you get to keep the premium that you sold the call for, which is $5.50. So what I like to do, though, I like to sell like right here, and as you can see, it's priced at $10.25. You can sell it. I like to get below what I paid for it to give me a little downside protection. Okay, so it can go down a little bit. If you go all the way up here and sell, say, the 4,500 call, you can see you're going to sell it for $2 and 2.7 points, or about $10 or $12. But if the future starts falling, it's not going to be long. You're going to be losing. So I like to sell it with a little downside protection. And you will have to do the math. Now, what we'll have to do here, we can flip to this view, and what you can do is, you take your 44.80, which you would be selling it for, add the 10.25 to it, which would bring you to 44.90 and a quarter. Well, that's above, about 8 points above what the current future is. Well, if you were to, so let's go down here to the 44.50. Okay, 44.50. You're going to sell it for 33 points, so that's 44.83 and a half. It's about 1 point above it, so that's a lot of downside protection, but only 1 point above it. You're only going to make $5 on it, so it's not worth trading that. You have to take your strike price you get it called away from, plus the credit you receive. So going down 32 points below is too far below. You're not, it's not going to be worth taking all the risk to make $5. So right here, if you now this is mispriced at $3. It's going to be up here somewhere in the middle. It's showing here about $17.75. So let's say $17. That would give you 87, give you 5, it'd be $25, or $25 is what it's going to boil down to. So that's the premise of a covered call. So I hope this video helped you to understand what we're trying to do here.